Dear patron, welcome to this month's edition of our market commentary, where we reflect on the key economic and market developments both globally and within India. August 2025 marked a phase of market divergence. The enactment of 50% US tariff on Indian goods reignited trade tensions, pressuring export-heavy sectors and weighing on short-term market sentiment. India's Q1 FY26 GDP growth surprised on the upside with 7.8% year-on-year growth rate. CPI inflation also fell to a multi-year low of 1.55%, anchored by favorable base effects and easing fuel prices. Rural recovery gained traction with a normal monsoon and healthy kharif sowing, supporting the consumption outlook. High-frequency indicators like PMI at 65.2, GST collections and e-way bills stayed resilient. Indian equities consolidated modestly in August 2025 amid global volatility, with only auto and FMCG sector delivering positive sectoral performance. Domestic institutions inflows to Indian markets was to the tune of $9.5 billion, which absorbed foreign institutional outflows of $2.6 billion, reinforcing domestic participation. Global market update. August saw a sharp divergence in equity performance across regions. China's CSI 300 surged 10%, driven by property sector support, easing local conditions, and a broader pro-growth policy effort. In contrast, India underperformed, facing near-term pressure from the US decision to impose a 50% tariff on select exports. US 10-year GSEC yield eased 14 bips to 4.23%, reflecting safe haven demand and rising expectations of a Fed rate cut in September 2025. Macro signals across developed markets remain mixed. US Q2 GDP was revised up to 3.3% annualized, supported by healthy household spending, services growth, and fall in imports. Eurozone's composite PMI rose to 51.1, a 15-month high, while inflation cooled to 2.2%, reinforcing the ECB's policy pause. Japan's composite PMI rose to 51.9, driven by growth in service sector while manufacturing still lags. Global investor positioning turned more selective amid rising trade frictions, persistent geopolitical risks, and divergent monetary policy paths. US equities gained 1.5% in August. Additionally, European markets also gained, with the Stoxx Europe 50 up by 1%. GST 2.0, a timely catalyst for consumption growth. According to most updated news flow, only two rates would excess 5% and 18%, along with the removal of 12% and 28% GST rate slabs. 40% GST slab for sin or luxury goods to offset the revenue loss for the center and state governments. The basic objective is to provide consumption the much needed boost where the growth has lagged for the last 3 to 4 years. According to media reports, the revenue impact from GST slab rationalization could range between 500 billion rupees to 1 trillion rupees. However, the broad consumption multiplier may be significantly higher, potentially unlocking 2 to 5 trillion rupees in incremental demand over time. Unlike income tax rebates, which are expected to release 1 trillion rupees into the hands of taxpayers, GST reforms benefit a wider population base. Its effect should be more visible in S2 FY26 and beyond. Importantly, GST and tax cuts are not one-time boosts, but can alter long-term consumption and saving patterns. This may eventually reflect in the company's profit and loss accounts through stronger earnings, higher return on equities, and potential market-wide re-rating. The clearest potential beneficiaries of the proposed structure could be entry-level autos, insurance, cement, and building materials and white goods. A reduction in GST on small cars and two-wheelers from 28% plus cess to 18% could enhance affordability and lift dealer throughputs as demand normalizes. For insurers, a move from 18% to 5% or nil would significantly improve premium affordability supporting penetration in protection and retail health products. Cement, currently among the most heavily taxed inputs at 28%, could shift to 18% under the rationalized proposal. This would improve unit economics for housing, infrastructure, and drive volume gains across building materials and real estate space. In the consumer durable segment, a GST cut on ACs and large format TVs from 28% to 18% could support white goods demand, particularly in formal retail. Items already taxed at 18% may see limited incremental benefit. In other categories, rate alignment in apparel and footwear towards the 5% and 18% slabs could favor value-led formats. Online gaming, which currently attracts 28% GST, faces the risk of moving into a 40% sin slab, along with tobacco, alcohol, and luxury goods. Overall, GST 2.0 has the potential to revive formal consumption, improve affordability across key segments, and support earnings visibility in sectors aligned with domestic demand. Tariff of 50% levied by US, pressure on labor-intensive sectors. On 27th August, US imposed an additional tariff of 25% on broad set of Indian goods, taking effective duties to 50% for several key categories. India's total exports to US as of FY25 stands at $87 billion, out of which $60 billion would attract 50% tariffs, while 30% of India's exports like pharmaceuticals, semiconductors, electronics, and petroleum products have been exempted from the reciprocal tariff. Labor-intensive sectors such as textiles, gems and jewelry, leather, shrimps, meat, processed foods are likely to face the sharpest hit. The timing of the move, the weak global trade sentiment, adds pressure on MSME-led clusters with high employment dependence. In the 90-day window which was provided by President Trump, exporters have front-loaded shipments, but there has been cancellations of orders from major buyers in US. Immediate impact would be loss in revenue and potential job losses if alternate avenue is not looked out for. Negotiations are expected to continue through bilateral and multilateral channels, even as India accelerates diversification through ongoing FTA talks with the EU, UK, and others. In our view, government may need to consider interim policy relief, such as faster GST refunds, subsidized exports credit, and targeted incentives to support vulnerable sectors. Drawing from the COVID-era policy playbook, a calibrated support package could help mitigate near-term disruption and sustain export competitiveness into FY26 and beyond. Q1 FY26 results reflect early signs of recovery, but earnings breadth remains narrow. Aggregate profit after tax for the broader universe of Nifty 500 index stocks stand at 11% YOY and 6% on revenue growth, broadly in line with consensus expectation, but heavily concentrated in cyclical sectors such as metals, cement, energy, infrastructure, materials, and financials, excluding banks. In contrast, banks, auto, IT, staples all detracted from aggregate growth, signaling uneven sectoral contribution and limited visibility for a broader re-rating at this stage. Mid-caps led with 15 to 16% profit growth and healthy margin expansion, while large caps grew by 10 to 11% despite narrow leadership. But small caps profit declined by 1.5% during the quarter as the sales growth remained flat. The current earnings warrant a positive outlook towards mid and large cap space with primary focus on volume play while observing caution in small caps until earnings durability and margin visibility improve. For Nifty 50 companies, profit grew by a modest 8% YOY during Q1 FY26 quarter as the participation remained limited. Subsequently, FY26 Nifty EPS has been revised downwards by 1% to INR 1165, while FY27 earnings estimates is at 1335, implying 13% EPS CAGR between FY25 to FY27. A durable re-rating will require broader sectoral participation and sustained earnings upgrades beyond the current leaders. On a global front, India's valuation premium continues to face pressure from modest USD earnings delivery. Nifty 50 index US dollar EPS growth stood at 4% YOY in June 2025, placing India in the lowest half among global market peers. Over CY25 to CY26, India's US dollar EPS CAGR is projected at 9%, well below China, which is at 18%, and MSCI EM at 14%. Yet Nifty 50 trades at 19.4 times 2-year forward earnings compared to MSCI EM's 12.6 times. This gap highlights the need for stronger earnings momentum and broader sectoral contribution to sustain relative valuation. Looking ahead, H2 FY26 presents a credible setup for earnings acceleration. The strong 7.8% GDP growth in Q1 has set a firm base, while rate cut, transmission, income tax relief, post-monsoon rural recovery, public capex, and likely GST rationalization can drive broader profit momentum. Global headwinds persist, but domestic levers are aligning. A sustained market uptrend, however, hinges on these macro drivers translating into visible earnings delivery and upward revisions of estimates, which remain the key catalysts for re-rating and incremental flows. Domestic macro update. India's Q1 FY26 GDP rose 7.8% YOY, ahead of expectations and higher than 6.5% in Q1 FY25, driven by a favorable base, strong public capex, and recovery in services and agriculture. On the supply side, real gross value added grew 7.6% YOY, led by 9.3% growth in services. Early Q2 indicators point to a steady start. Business activity, GST collections, e-way bills, and rural demand remain healthy compared to the elections disrupted Q2 FY25. For FY26, a combined push from income tax, GST rate cuts alongside RBI rate easing is expected to support consumption, particularly in urban discretionary demand. India's headline inflation hit an 8-year low of 1.55% YOY in July. Primarily, a favorable base effect aided moderation, supported by a sequential softening in fuel inflation. Core CPI printed eased to 4.1% YOY from 4.4% in June 2025. A normal monsoon, evenly distributed rainfall, and a 4% growth in Kharif sowing have supported rural sentiment and improved near-term crop prospects. Healthy reservoir levels also enhance visibility for the upcoming Rabi season. Combined with favorable base effects, these factors are likely to keep food inflation well anchored through FY26. India's high-frequency data continues to signal resilience. The composite PMI rose to 65.2 in August, marking a 2-decade high, while the US and Eurozone PMIs recovered modestly to 55.4 and 51 respectively. China and Japan remain below 50, indicating continued contraction. GST collections and power demand remain stable. Against this backdrop, with the expectation of consumption demand revival, India's macro positioning appears healthy going into H2 FY26. Currency movement. The rupee depreciated 0.7% in August, moving from 86.8 to 87.6 per USD, reflecting pressure from renewed US tariffs and realignment of export flows. This external pressure is expected to widen the current account deficit, although FY26 projections remain manageable at 1% to 1.2% of GDP, up from 0.6% in FY25. Also, India's FX reserves remain robust at $695 billion US, providing a strong buffer. Easing crude prices, resilient services exports, and remittances offer additional support. The RBI has managed volatility through timely interventions, though not defending any specific level. Most likely, the INR may remain range-bound with mild depreciating bias into Q3 FY26. While external risks persist, strong reserves, easing crude, and a credible policy framework limit tail risks. In short, we can expect currency movement to remain orderly, barring a fresh escalation in global trade uncertainty. DII's anchor markets as FIIs stay guarded. FIIs for the month of August were net sellers to the tune of $2.6 billion, while domestic institutions bought net $9.5 billion during the month. Despite $12.8 billion in FII outflows through YTD CY25, benchmarks have remained stable, with the Nifty 50 up 3% YTD, supported by near-peak DII ownership and consistent domestic inflows via SIPs, EPFO, and insurance. Monthly SIP contribution have stayed above 200 billion INR, absorbing foreign selling pressure. Commodities review August 2025. Oil outlook. Brent crude declined from $73 at end July to $67 to $68 per barrel in August, reflecting post-summer demand moderation in the US, softer global freight activity, and a steady OPEC supply setup. A brief price lift from a 2.4 million barrel US inventory draw was short-lived as seasonal demand softened. For India, lower crude prices eased the import bill and reinforced the disinflation narrative into S2 FY26, offering relief on both inflation and current account balances. Going forward, oil is likely to remain range-bound in the mid-60s to low 70s. While upside risks stem from fresh supply shocks, downside persists if OPEC loosens cuts or global growth underperforms. Consensus now points to a largely sideways profile for the remainder of FY26. Gold traded US dollar 3,300 to 3,400 per ounce through August, supported by safe haven flows, global trade tensions, and heightened policy uncertainty. A softening US dollar and a higher probability of a September Fed rate cut acts as tailwinds. Central banks continue to anchor demand. The World Gold Council in its 2025 survey showed 43% of central banks plan to increase reserves over the next 12 months, citing diversification, crisis performance, and de-dollarization. With inflation uncertainty still elevated and real yield expectations moderating, gold's relative appeal remains strong. Unless real rates rise meaningfully or geopolitical tensions ease sharply, the price trend is likely to stay firm. Navigating through uncertain times. Despite growing comfort with the global macro conditions, policy pivots and geopolitical risks remain in play. In this environment, gold and digital assets continue to attract allocations. That said, the long-term case for Indian equities remains strong. With macro stability, falling rates, and improved consumption drivers, India enters H2 CY25 with a positive momentum. This is a phase to stay invested, particularly in companies aligned with domestic demand and structural tailwinds. Our portfolio allocation continues to favor domestically oriented companies, fundamentally strong businesses, with visibility across growth, margins, and policy tailwinds. The emphasis remains on sectors that are likely to benefit from lower interest rates, steady rural demand, and infrastructure-led multiplier effects. Financials, selective preference within banks and NBFCs. We remain selectively positive on large private banks, which continue to trade at a discount to their 5-year average valuations, despite stable asset quality and earnings growth. The RBI's 50 basis points repo cut and 100 basis points CRR reduction have eased funding costs and supported system liquidity. This strengthens the outlook for credit growth across retail and MSME segments. At the margin, small private sector banks may also benefit in this kind of environment, though allocation remains biased towards lenders with strong liability franchises and underwriting discipline. We are also constructive on select PSU banks, which offer valuation comfort, high dividend yield, and improving profitability metrics. NBFCs, particularly in housing and SME lending, are well positioned to gain from the easing rate cycle, as lower cost of funds improve spreads and incremental demand. Domestic pharma over export-focused peers. We favor domestic-focused pharmaceutical companies given the continued pricing pressures in the US generics market and recent rupee stability. Domestic players benefit from expanding healthcare penetration and consistent volume-led growth. During the phases of uncertainty, defensive positioning should provide the much needed cushion to the portfolio. Energy and gas utilities. Softening crude prices and stable currency dynamics have improved the operating outlook for gas distribution companies. Insurance and real estate. Private insurers continue to gain market share, driven by rising health and motor coverage demand. Formalization, digital adoption, and regulatory reforms add to structural tailwinds. We also like real estate companies, which continues to gain on the sustained demand at the premium end, and also the end buyers benefit from the much needed rate cuts. Autos and consumption. We are positive on two-wheelers and select passenger vehicle OEMs, where rural uptake and input cost relief support recovery. Within consumption, we prefer value-focused discretionary segments, including affordable fashion, retail, and select durables over staples, which face valuation constraints and slowing volume growth. Cautious stance on export-oriented sectors. We remain cautious on IT, export-oriented pharma companies, and auto exporters, given soft global demand, weak discretionary spend, and limited visibility on large deal flows, and also the tariff uncertainty. INR stability offers some relief, but earnings risk remains skewed towards the downside in the near term. Themes we like: China plus one and global supply diversification, growth revival, rural recovery, and affordable consumption, rate sensitive plays, NBFCs, PSU banks, select private banks, real estate plays, Make in India, digital infrastructure and public capex, defense export and select manufacturing opportunities, transition in the energy sector. Thank you for your continued trust and support. We look forward to connecting with you again in our next monthly update.